How are farmland leasing rates determined? Welcome back to your go-to channel for everything related to farmland investment strategies and agricultural real estate trends. Today, we are addressing a question that many are asking. How are farmland leasing rates determined? With recent fluctuations in agricultural markets, understanding this topic is more relevant than ever. Farmland leasing rates are influenced by several important factors. First, local market conditions play a significant role. The balance between the supply of available farmland and the demand from farmers looking to rent affects pricing. When there is an abundance of land and fewer farmers, rates may decrease. Conversely, when demand is high and land is limited, rates tend to increase. Next, the quality of the land itself is a key consideration. Land that has fertile soil, effective drainage, and reliable water access can command higher leasing rates. On the other hand, land with issues such as erosion or flooding typically leases for less. Crop prices also impact leasing rates. When prices for commodities are high, farmers are often willing to pay more for land because they anticipate greater profits. However, if crop prices fall, this can lead to lower lease rates as farmers may not be able to afford higher payments. Input costs, including expenses for seeds, fertilizers, and fuel, are another factor. Rising input costs can limit what farmers are able to pay for leases, which may slow increases or even cause rates to drop. Government programs and subsidies can also affect leasing rates. Support programs for farmers may enable them to afford higher lease payments, while changes to these programs can have the opposite effect. The terms of the lease are important as well. Short-term leases might have different rates compared to long-term agreements. Cash rent leases, where tenants pay a fixed amount per acre, are common. Crop share leases, where landowners receive a portion of the crop, can adjust with market conditions. Location and infrastructure are crucial factors too. Farmland that is close to markets and has good roads and storage facilities is often more desirable, leading to higher leasing rates. Finally, local customs and the relationships between landowners and tenants can influence rates. In some regions, long-standing agreements and trust can keep rates stable, even in changing market conditions. In summary, farmland leasing rates are determined by a combination of local market conditions, land quality, crop prices, input costs, government programs, lease terms, location, and local customs. Understanding these factors can help both landowners and tenants make informed decisions in the agricultural real estate market.